Hello and welcome to this TIA Markets daily market commentary for Tuesday, the 28th of January 2020. Monday saw a risk aversion at elevated levels as markets were overcome with concerns around the spread of the coronavirus. Equities and yen crosses suffered the most, with gold being the main beneficiary. Today, however, has seen a partial correction of those moves, although there is little in terms of positive news to warrant that reaction. However, sometimes markets just move too far and too fast for their own good. While the Nikkei would still post a 0.5% decline on the day, with Chinese and Hong Kong equity markets closed for the New Year celebrations, European stocks would all show impressive gains. The DAX would close up 0.7% and the FTSE 100 up 0.8%. Even with the reversal in equity markets, dollar yen would initially trade lower to 108.76, while euro yen would make a new low down to 119.81. US equity futures had indicated a positive start for Wall Street, and despite mixed durable goods data, the dollar would begin to rally with equities. As Europe headed home, euro dollar would test 110 figure, sterling a low of 129.85, while dollar yen would rally up to 109.20. Euro yen would also bounce, hitting an interim high of 120.10, as gold would also reverse from 1580 down to a low of 1568. The Dow Jones would initially open up 100 points and ultimately bounce by 280 points at its best levels. However, as the day progressed, the reversal of yesterday's moves will continue. Equities aside, FX would stray from the earlier dollar strength. Euro dollar squeezed back to 110.22, cable up to 130.25, and euro yen up to 120.30. By the end of the day, the Dow Jones would close well off its best levels, but was still up 180 points on the day. The S&P and Nasdaq would fare better, up 1 and 1.47% respectively. And to the end of the day, we had Apple's earnings after the bell, which came in better than expected. The stock would rise up almost 2% in after-hours trading. So everything is good with the world again, it would seem. How fickle our markets are. On a day which saw no new alarming headlines on the coronavirus, we had quite the reversal. I guess no news is good news. And now all eyes turn to the Federal Reserve meeting tomorrow and the ensuing interest rate decision, and of course, the beloved press conference. Stay tuned for that. Looking at the technicals, well, when markets are overreacting to situations like we currently have, technicals can become a little clouded. The last 48 hours have seen some wild swings, with traders generally abandoning their charts and adopting more of a herd mentality. So what pearls of wisdom can I bring you? When charts resemble the scribblings of a 3-year-old, that can be challenging. So I turn to gold for a little inspiration. I have up in front of us here an hourly chart, and I've drawn a trend line off the low after the 1611 high. So we made a 1611 high here at the beginning of the month, which was when things were getting a little agitated in the Middle East to begin the year. And then we had a de-escalation, which saw gold come off, and we came down to this 1535 to 68 area here, which incidentally was also a previous high back in September of 2019. So for a market that appears to be bullish for gold for whatever reason, some gradual appreciation rather than the whipsaw type of moves we're currently seeing would definitely be constructive. So keep an eye on this trend line here over the next couple of sessions and see if we hold and hopefully make some slow gains, or if we see a deeper correction than we have seen today. It will certainly be interesting, especially with the Fed meeting upon us. Hope everyone had a good day, and I look forward to speaking with you tomorrow. Cheers.